Hello. In this video, we'll continue with the characterization of gains and losses and focus specifically on capital gain and loss mechanics. Now recall from the general concepts video that when a taxpayer has a preference with respect to certain gains and losses, mainly individuals, the taxpayer prefers, when it's a gain, to have long-term capital gain because of the preferential rates, because of the lower than ordinary income rates. And when it's a loss, the taxpayer generally prefers ordinary losses because ordinary losses have less limitations than capital losses, and also ordinary losses provide more tax benefits than capital losses do when you think about the benefit, because you're lowering the 40% rate rather than, say, a 20% rate for capital gains. So you get more of a benefit when it comes to the tax benefit of a loss, providing a deduction. Now, when we go through capital gain and loss mechanics, you really have to take into account the other characterization videos that I've gone through. Defining a capital asset, how exactly we get to capital gain, capital loss, Section 1231, Section 1245. So this video should be one of the last videos you watch when it comes to the characterization videos. If you haven't watched Defining a Capital Asset, the characterization general concepts, Section 1231, holding period, or the 1245 videos, I recommend stopping and watching those videos now. There's plenty of videos on characterization you need to watch. This should be one of the last ones that you watch. So the first step in the capital gain loss mechanics is to identify any capital gains and losses. So we want to identify any capital gains, and this includes long-term and short-term. We're going to get to that part later on. Any capital gains and loss. So identify any capital gain and loss that are out there. Now we do this step after we do Section 1245 and Section 1231 analysis. So if you don't know about Section 1245 or Section 1231, please watch those videos. We do the capital gain and loss mechanics after we've done the Section 1245 and Section 1231 analysis. So this is the first step. We identify any capital gains or losses. And if you recall from our previous discussion, to get capital gain or capital loss, under the normal rules, we have to have a sale or exchange from a capital asset, and that gives us capital gain or loss. Now, as an exception with respect to Section 1231, you can get capital gain or capital loss when you have involuntary conversion, but usually, almost always, you need that sale or exchange requirement. So once we determine our capital gains and losses, and again, after we determine Section 1245, because Section 1245 can recharacterize capital gains into ordinary gain. And Section 1231, when you net everything, you might get ordinary items, and you might not have any capital. So it's very important that you do this step, identify any capital gains and losses after Section 1245 and Section 1231 analysis, the netting and the recapture. The next step is to classify long-term and short-term capital gains. So we've talked in other videos, other characterization videos, about the distinction of long-term and short-term capital gain. Long-term capital gain means any capital gain that the property has been held for more than a year. Short-term is a year or less than a year. So we'll abbreviate long-term as LT and short-term as ST. We're going to use abbreviations a lot later on. So when you see the two letters LT, that's for long-term, and ST for short-term. Again, long-term more than a year, short-term a year or less. And if you did not watch the holding period video, please stop and watch that video to determine how we calculate holding period and how we count the days to determine long-term and short-term. Okay, once we separate the long-term and short-term gains and losses, capital gains and losses, we then are going to net the longs and shorts separately. So we're going to net all the long-term items and the short-term items separately. We net them. So we net the longs and the shorts, we net them separately in their own category. So, I mean, if the taxpayer has a lot of capital gains during the year, some of the short-term items produce gains, some of the short-term items produce a loss, you're going to net the short-term gains and losses to get a net number. It could be a net gain, could be a net loss from short-term activities. You're going to net the longs. the taxpayer could have long-term capital gains and long-term capital losses. We net that number again, and we separate the long net number and the short net number of the capital gains. So the next step, and this is probably the most important step, is that we net the longs with the shorts. So the step above, we are separating the longs and the shorts that we're netting. We're separating them. But then we net those numbers. We net the longs and the shorts together. So we net the longs with the shorts. We net the longs with the shorts. And the general rule is that a short-term loss or a long-term loss can offset a short-term gain or a long-term gain. So basically, capital losses can offset any capital gains. That's really the practical rule. So as a general rule, any capital loss can offset any capital gain, whether it's long or short term. Now there's an ordering of this rule, and that's why we're going to go through 6 examples to see the possibilities. So what you see here are 6 different possibilities. Now when we assume these examples, let's assume that this is for an individual. I'm going to mention later on what happens if it's possibly a corporation. There's special rules if you're corporations. But we're going to assume that this is an individual. Now we have 6 different scenarios. We're going to walk through each one. So we go through the steps. This individual, in example 1, we identify the capital gains and capital losses after 1245 and 1231. We classify the capital gains and losses as long-term and short-term. Then we net the longs and we net the shorts separately. Okay? And that's what we've done right here. So after this step, in example 1, our net long-term capital gain is $75,000. Our net short-term capital loss is $30,000. So again, these are 6 different possibilities of how this could play out. So by netting the longs, let's say the taxpayer had both long-term capital gains and long-term capital losses. The net long-term capital gains means that the gains of the long-term capital nature, offset the long-term capital loss nature. And we got a $75,000 net number. The shorts, when we net those, let's assume we have a net short-term capital loss of $30,000. That means that the short-term capital losses offset the short-term capital gains by $30,000. See how that works? So here's our numbers to play with. That's what we have. We have net long-term capital gain of $75,000, net short-term capital loss of $30,000. So the next step is we net the longs with the shorts. And that's why that's what these 6 examples are here to show you. The 6 different possibilities of everything you can have. Obviously different numbers, but the different possibilities of the results. The different possibilities of the results. So the general rule is that capital losses can offset capital gains. The way it works though is because we net the longs separately and the shorts separately first before we net all the capital gains and losses, we do it in order. We do this first. This comes first. We net the independent categories, the longs and the shorts separately. But we eventually get to net all longs with shorts. And that's what we get to do here. So we net these 2 numbers. We have a gain of $75,000, a loss of $30,000. That means we have a $45,000 gain when we net those numbers. Because the gain is greater than the loss. And the difference is $45,000. See how we did that? $45,000 gain. Now, that item, that gain, because it's long-term in nature, because the long-term is what is being offset by the short-term, that means it's treated like long-term and it's going to be taxed as a long-term capital gain, which results in Section 1H, which is the preferential rates that I've been talking about in many videos, the lower rates. So whenever we say Section 1H, I'm going to talk about Section 1H later and how that works. But Section 1H is how we get to those lower rates other than the ordinary income. So this is the preferential rates, the Section 1H preferential rates. So whenever you hear the term preferential rates, we're talking about the lower capital gains rates, preferential. So that's how we do it. Based on our general rule, capital losses can offset, right? The net short-term capital loss of $30,000 can offset the net short-term capital gain, and we get $45,000. Now let's change it around. What if we have a net short-term capital gain and a net long-term capital loss, and the net short-term capital gain is $75,000, net long-term capital loss is $30,000. Again, we get a $45,000 gain, but what's different here? Now, the net long-term capital loss is offset the net short-term capital gain, but we still have net short-term capital gain. So now it is a $45,000 short-term capital gain, which is taxed at ordinary income rates. Ordinary income rates. This is the same rates that people that have compensation, when they're taxed. The high brackets. That's under ordinary income. So the preferential rates are much lower than the ordinary income rates. So you see that under a net short-term capital gain, yes, net long-term capital losses can offset that, which is good. But if you have any short-term capital gain after this step, it's going to be subject to ordinary income rates, which could be as high as 40%, and this could be high as 20% at the time of this video. When you're watching the video, these rates might have changed, by the way, so please take that into account. Okay, let's continue with the examples. What if we have a net long-term capital gain of $75,000 and a net short-term capital gain of $30,000? Well, we have two gains, right? They can't offset one another. Well, the $75,000 gain is a long-term capital gain, right? So this is a G for gain. This is a long-term capital gain, which is subject to Section 1H, which is the preferential rates. The $30,000 gain is a short-term capital gain, right? Nothing offsets. And again, short-term capital gains are subject to the ordinary income rates. The ordinary income rates. So see, there's a distinction. If you have a long-term capital gain after this netting, it's subject to the preferential rates, the lower rates. But if you have a short-term capital gain, it's subject to the ordinary income rates. So if you had a capital gain and you had to pick as a taxpayer whether you wanted it to be long-term or short-term, what do you want? You want the preferential rates. You want the lower rates. You want to be taxed at 20% at the time of this video rather than 40% at the time of this video. That's a 20% difference in taxes. You're saving 20%. That's a good deal, right? You prefer this. That's why it's preferential. That's why it's a preferential rates. Okay, let's continue to example 4. Now we're going to see when the losses are greater than the gains and how that works. And again, I want to reiterate that we're assuming the taxpayer is an individual because there's going to be a special rule I'm going to mention. Okay? So we have a net long-term capital loss of $75,000 and net short-term capital gain of $30,000. By the way, in all these examples, I use 75, 30. 75 is the greater number and 30 is the lesser number. Well, when we have a net long-term capital loss that's greater than net short-term capital gain, we subtract and we get $45,000, but it's not a gain anymore, it's a loss. Because the greater number is a loss, so we offset by the gain, and now we have a $45,000 loss because the loss is greater. See that? Whenever we have a capital loss, whether it's short-term or long-term capital, if it's an individual, $3,000 of the loss can offset ordinary income. It can be reduced. It can reduce ordinary income. This is $3,000 if you're single or married filing joint, $1,500 if you're married filing separate. We're going to use $3,000 because we're going to assume the taxpayer is single or married filing joint. The remaining amount is carried forward to the next year. So we carry forward to the next year. And by the way, it's going to keep carrying forward and carrying forward and carrying forward until the taxpayer dies and then just vanishes. It disappears. No one gets the benefit. All right? And that's going to be it's going to be in the nature of what it was. It was a long-term capital loss, right? This was a long-term capital loss. It keeps that same nature. So the $42,000 carry forward is also going to be a long-term capital loss. So when you do this netting next year, you bring over this $42,000 long-term capital loss to the next year and you go through the same analysis. You bring it here and you go through the analysis using that $42,000 long-term capital loss carry forward. And again, it keeps carrying forward into the future, into the future, into the future as an individual, and it will be lost when the taxpayer dies. Now, interesting little quirk. What if a taxpayer is single and has a bunch of capital losses that they're trying to carry forward, but they have no capital income? They have, let's say they have $1 billion of capital losses, and they don't foresee them being able to use those capital losses to offset anything, and they're single. Well, that taxpayer, if they could find somebody to marry that has capital gains, the two could marry one another. The capital loss, let's say the husband has the capital losses and the wife has the capital gains in the future because of a business or stock or something. Well, if they marry, guess what? The capital losses from the husband can be used to offset the capital gains of the wife in the future because now they're married. Interesting, right? And some people have done this as sham marriages. I'm not saying that you should do it, right? It's obviously unethical. But they've done it as a sham marriage to take advantage of this rule, to take advantage of the capital loss, to take advantage of capital loss carry forwards. And if you don't think you're going to be able to use them, why not find someone to marry? Especially when you're going to be saving, it's going to save 20% on the capital gains because you can offset. Okay, if you have $100 million of capital gains in the future because you might be selling your business or selling some stock, right? You're a billionaire, you have $100 million of capital gains that are stuck in your property, and then you marry this person that has, let's say, $100 million of capital losses, and the next year they use them because they sell the property at capital gains, right? You're saving $20 million. That's $20 million. That's a lot of money, 20%, $20 million, right? That's interesting. That's just a little example, a little quirky, possibility. You don't have to really know that, but it's an interesting thing to mention. So again, it's important to understand that the capital loss, the $42,000, carries forward to the next year. We do the analysis, and it does stay as a long-term capital loss. It keeps that same character. $3,000 of that $45,000 can be used to offset ordinary income, wages, and whatnot during the year. Okay, the next example, what if we have a net short-term capital loss, which is greater than a net long-term capital gain? Again, we have a $45,000 loss, so I'm just going to put L for loss. Again, same thing, we have a $3,000 offset to ordinary income. We're allowed to do that, any capital losses, whether it's long-term or short-term. $45,000 loss, that is considered a short-term capital loss, right? Because it was a short-term, which is greater than the long-term capital gain, so it keeps that character. And then the remaining portion, the $42,000, carries forward to the next year as a short-term capital loss. We go through the analysis. It brings over $42,000 to next year, and it goes through. We identify capital losses. We have a $42,000 carry forward. Classify capital gains and losses as long-term, short-term. Well, it's short-term. Net longs and shorts separately. So obviously we use this. If we have any capital gains in the next year, we can use it to offset. And then we net the longs with the shorts. So you bring this in again. So that's example 5. Example 6. So this is the final possibility. So we saw 1, 2, 3, 4, 5. Obviously the numbers will be different in practice, right? They're not going to be 75 and 30. But these give you 5 of the 6 possibilities you can have and how we do them with individuals. What if you have a net long-term capital loss and a net short-term capital loss, 75 and 30? Well, we get to sum those numbers. 105,000 loss total. So this is very important. Okay, please listen to this. We have $105,000 capital loss total. So the first thing is that 3,000 of that loss can offset ordinary income. And that comes out of the short-term portion. This is a rule that's in the code. It comes out of the short-term capital loss. That's what it comes from. So that comes out of. So after this first 3,000, it reduces net short-term capital loss down to 27. The rest of the remaining portion, which is 102, gets carried forward. Carried forward to the next year. Now, when you're doing the next year, and you're classifying as short-term or long-term, this is very important. This is very important. We have to separate this out. So of the 102,000, all 75 is still considered long-term capital loss that carries forward to the next year. So 75,000 of this carries forward as a long-term capital loss. Now, we had a $30,000 short-term capital loss, right? Net short-term capital loss, but $3,000 was used to offset ordinary income in the current year. So only $27,000 carries forward as a short-term capital loss. That's very important. Again, that's the rule. We take the ordinary income. If we have a long-term capital loss, a net long-term capital loss, and a net short-term capital loss, we take the $3,000 offset of ordinary income from the short-term capital loss. Let me say it again. Please write this down. If you're taking the CPA exam, taking a law exam, taking an accounting exam on tax, you need to know this. If you have a net long-term capital loss and a net short-term capital loss during the year, You can do the $3,000 rule, but the $3,000 offset of ordinary income comes out of the net short-term capital loss. So we have $102,000 that carries forward to the next year. 75, all of the long-term capital loss carries forward, but only 27. That's a 27. Sorry, 27 of the 30, because the 3,000 was ordinary income, right? 30 minus 3 is 27. 27,000 carries forward as a short-term capital loss. Very important distinction. Very important distinction. Okay? So, now that we've gone through all 6 possibilities, we see that some of them, we have ordinary income rates, where we see the short-term capital gains, right? Ordinary income rates. And that's where you apply the rates that you know, the tax rates, the brackets, right? At the time of this video, the highest tax rate is 39.6%. I've been saying 40%, and that's what we're talking about. That's the ordinary income rates. The same rates that you apply on compensation. And the time when you're watching the video, the rates might have changed. So please look at that. But what about this Section 1H preferential? So the next step after you've gone through this is obviously the things that go to the ordinary income rates. You know how to do that. You've been doing that all along in your income tax class. You apply the rates that you've learned, the normal tax brackets. But if you have to deal with Section 1H, there's special rates for different things. So the normal capital gain rate. So Section 1H is broken into a few different tax rates. There's the normal long-term capital gain rate, which at the time of this video is 20%. It's 20% is the highest. You might actually have lower than 20%, but 20% is the highest. So that's one type. Another item in Section 1H is unrecaptured Section 1250. And I mentioned this in the Section 1245 recapture video. Unrecaptured Section 1250 deals with depreciable real property. It's the portion, if you applied Section 1245 to Section 1250 depreciable real property, the recapture, that portion, okay, you'd be taxed at a rate, a special rate. At the time of this video, the highest rate is 25%. Well, it's 25%. Rather than, again, ordinary income rates, which at the time of the video are about 40%. Another item is collectibles. Collectibles have a special rate. At the time of the video, it's 28%. So this is the order. This is the lowest rate, the normal long-term capital gain, to the collectibles, which are the highest rate. So again, at the time of this video, the highest normal long-term capital gain rate is 20%. The collectibles are 28%, and the unrecaptured 1250 is 25%. This might change based on when you're watching the video. So normal long-term capital gain is just what we normally classify long-term capital gain. Really, it's like, think of it like there's 2 special rules to capital gains of the lowest rate. There's the unrecaptured Section 1250, which applies to, please write this down. Unrecaptured Section 1250 applies to depreciable real property. Depreciable real property. If any depreciation was taken, you have, even whether it's taken or not, you got to go through Section 1250 unrecaptured portion. And what it does is it applies Section 1245, the same rules. You look at the lesser of the realized gain or the amount of depreciation taken, and you recapture that amount. And that amount is subject to a rate that's higher than the normal long-term capital gain. Again, at the time of this video, it's taxed at 25%. Collectibles have a 28% rate, which is the highest. Now, collectibles are things like baseball cards, antiques, things that are collectibles, like we normally think of postage stamps that have collectible value. What about gold coins? This is interesting because some people argue that, yes, gold coins are collectibles. Like if you get them from the mint or whatnot, they have these proofs and whatnot. But what if you are just trading gold? Well, gold as an investment is a capital asset, and it's not considered a collectible. But you can argue that some gold coins, they have a gold value, and they actually are not collectibles. But some people say they are. Now, I will tell you that gold coins, through the case law, almost always are viewed as collectibles. So you can't get away from that. So if the issue becomes, what about gold bars versus gold coins? Gold bars would seem more like non-collectibles, and the gold coins seem more like collectibles because it does have some collector's value. So that's really Section 1H. Again, we apply the normal long-term capital gain preferential rates that we've been talking about. That's if we have Section 1H items. So here in Example 1, we have Section 1H. Example 3, we have Section 1H. All the losses just simply offset and they carry forward. Okay? They offset and they carry forward. So another thing I want to mention is that corporations have special rules when it comes to the capital gains and capital losses. They have more limited rules. They're more limited than the individuals are. That's very important. Now, this could change in the future, so please look when you're watching the video. But at the time of the video, the general rule is that there is no $3,000 offset against the corporation's income, ordinary income. It's simply just capital losses can offset capital gains. Same rules that we apply here. But there's no $3,000 offset against ordinary income. Very important to understand. Okay? And in addition, it's not a full carry forward. There's a carry back of a certain number of years and then carry forward. Again, please look at that. So there is no $3,000 amount for corporations. And again, there's a carry back portion where you can actually go back and get a refund. And you carry forward a portion as well. So please look at that if you're watching the video. Okay? What the current rule is when you're watching the video. It's just simply just Googling it, looking it up in the code under the the characterization rules for capital gains and losses. The last thing I want to mention is, let's talk about taxpayer choice. So a taxpayer choice. So we talked about if a taxpayer has capital gain, the taxpayer is definitely going to prefer to have the long-term capital gain, right? The long-term capital gain. Because it's taxed at preferential rates, which even if you're at the collectible rate, is much lower than the highest rate of ordinary income rates. Okay? Is much lower. But what if you have capital losses? If you have capital losses, think about it. Think about the steps. If you think about the steps, we identify capital gains and losses, okay? We classify long-term and short-term, okay? That's a bright line rule. Short-term is a year or less, long-term is more than a year. We net the longs and shorts separately, and we do that before we net longs with shorts. So what happens if a taxpayer has, let's say, short-term capital gain, right? Short-term capital gain, short-term capital loss, and long-term capital loss, right? If a taxpayer has short-term capital gain, short-term capital loss, and long-term capital loss, then the short-term capital losses and the short-term capital gains get to net one another. These two will net, and the long-term capital loss will flow to the next level. So that we net, so we get the net shorts from this number, and we get the net longs, which is just one number. It's the long-term capital loss, which flows over to the next category. Okay? It flows over to the next category. So that's an example where whether you net or not, you're going to have that. Okay? But what if we only have one capital loss? If we only have one capital loss, what would you rather have? If you only have one capital loss, what would you rather have? Well, it really comes down to you rather have the short-term capital loss over the long-term capital loss. And the reason for that is let's change around our little example here. Let's say we have short-term capital gain of $50,000. And also we have long-term capital gain of $50,000. If you had a $25,000 capital loss, and you got to pick whether it was short or long-term, right? You could pick because you know when you're going to sell it. What would you rather have and why? What would you rather have? Well, think about it. Let's just go through the examples. If we did a long-term capital loss, under the netting of this right here, these two would net. And you'd have a net long-term capital gain of $30,000. You'd have a net long-term capital gain of $30,000. And you would still have short-term capital gain of $50,000, which is subject to ordinary income rates. So you would have this example. You would have a net long-term capital gain of $30,000, which would be subject to Section 1H, and you would have a net short-term capital gain of $50,000, which would all be subject to ordinary income. What if we change that around? What if we did this? If we change that capital loss, if we have the ability to do that, a short-term capital loss of $20,000, we net these two now. So now we have a long-term capital gain of $50,000, a net long-term capital gain of $50,000, which is subject to Section 1H, and a net short-term capital gain of $30,000, which is subject to ordinary income rates. So what would you rather have? Would you rather have a higher net long-term capital gain or a higher net short-term capital gain? That's really how you phrase this question. Well, you obviously rather have the higher net long-term capital gain because it's subject to a lower rate. It's subject to the lower rate. So if you were able to pick, you would prefer this option because it lowers the short-term capital gain rather than long-term capital gain because the short-term capital gain is subject to a higher rate. See that? So if you had a choice between picking between a short-term capital loss or a long-term capital loss, and neither would offset the full amount, you rather offset the short-term capital gain first. That's if you didn't have enough to offset both numbers. That's if you only had enough to offset some of one. Okay? So we prefer, if it's a capital loss, to be a short-term capital loss because under the ordering rules, a short-term capital loss will offset short-term capital gains first. Do you see that? That's a very important thing to understand. I just want to recap one thing. So we go through the items. We identify capital gains and losses, again, after section 1245, 1231. We classify capital gains and losses as long-term, short-term under the more than a year and a year less rule. We net the longs and shorts separately. That's what I was just showing you. We do the longs separate from the shorts. We net a long-term capital gain, a long-term capital loss, a short-term capital gain, a short-term capital loss. You might not have one or the other or one of each thing or whatnot. Once you do that, you net the longs with the shorts. And we went through 6 possibilities of what you could see. And by the way, if you only had one of these items, then you see what happens because I showed you the results: long-term capital gain, short-term capital gain, long-term capital gain, short-term capital gain, long-term capital loss, short-term capital loss. So I showed you all the possibilities. So if we result in a long-term capital gain after netting, we have section 1H, but if we have short-term capital gain, we have ordinary income rates. If we have both, then it's both things. If we have a long-term capital loss, 3,000 offsets ordinary income, and then we carry forward the remaining portion as a long-term capital loss. If we have a short-term capital loss, we do the same thing, 3,000 offsets ordinary income, but the carry forward is a short-term capital loss, so it keeps the character. That's what you see when you compare examples 4 and 5. If we have both 75,000 net long-term capital loss and a 30,000 net short-term capital loss, again, we're allowed to use 3,000 to offset ordinary income. That comes out of the short-term capital loss. Write that down if you didn't write that down earlier. It comes out of the short-term capital loss. The remaining $102,000 carries forward and it keeps the character. All 75,000 and 27, which is a 30 minus a 3, which is 27, that's going to carry forward to next year as a short-term capital loss. So you see how everything plays out when we do the netting. So again, all you really can do now is just change the numbers around. So once we get to the next step, we look under section 1H. All the ordinary income items, we simply apply the ordinary income rates. It's that simple. All the items that we carry forward, we do this analysis next year. The 3,000 offset against ordinary income or whatever portion up to 3,000. So you only have $2,000 loss, you just do 2,000. It's up to $3,000. That amount offsets ordinary income, which is good. You want that because ordinary income is at the higher rate. But the section 1H, the normal long-term capital gain items are at the lowest rate, which again, at the time of this video is a maximum of 20%. But there is under-captured section 1250, which is on depreciation of buildings and collectibles. Those have higher rates under these things, but again, they're lower than the ordinary income rates. Those are think of those like special rules. And then finally, corporations have more limited rules, which I talked about. There's no 3,000 offset, and you're allowed to carry back some, and then you have to carry forward the remaining up to a certain point. So where individuals carry forward indefinitely, the corporations, they have to stop at a certain point, a certain number of years. And then taxpayer choice is important. Obviously, if you only have one capital gain and you get to pick whether it's long or short, taxpayer wants long-term capital gain. So the taxpayer should hold the property for more than a year. But if you only have one capital loss and you have 2 capital gains and the taxpayer can pick, the taxpayer wants the short-term capital loss because as we saw in that example, if we only have enough to cover a portion of one of them, we rather offset the short-term capital gain first because it's going to lower that ordinary income item. Okay, again, I hope you enjoyed this video. Please rewatch this. Rewatch this until you get this down. This is really mechanical. That's why it's called capital gain and loss mechanics. And it does take some time. So I hope you enjoyed this video. And please make sure that you've watched the other characterization videos because when you view this all together, it really does help understand what exactly is going on here.